Good morning, and thanks for joining us here on Treasure Coast Solutions. Wednesday morning, 9 to 10 o'clock. We talk about almost nothing. No, we talk about whatever we want. That's the show. Yeah, it's about a little bit about economics, a little bit about some of the national stuff going on, a little bit about the some politics, I guess. I don't like to talk too much about the politics, or at least say I'm talking too much about politics, because when I do that, then Greg has to store all this information so that there's equal time for anybody else. But I guess that's only if it's an election year. And so far, no, we're not going to talk about any. It's as far as I know, based on Iowa, it's not an election year yet. So because I think those votes still aren't in yet, so we can't truly call it an election year until we've had that Iowa caucus, and it's still out there waiting to hatch. But anyway, my name is Mark Breckbill. I'm a local CPA. Also have worked in the banking industry for a number of years, had my own CPA firm for a number of years. Prior to that, worked with one of the big firms, a couple of the big firms, Arthur Andersen McGladrey. So I've had a little bit of exposure to both Wall Street and Main Street over the last 30 years or so, 25 years or so. It's been mostly, or 30 years, it's been mostly Main Street. But did have some experience with the SECs, with the big boys. Actually, when I was with Andersen, we were I was in the banking division. We handled most of the big banks out of Chicago, and so it was an interesting experience. You get to see some of these things really up close, and to see how some of the finance and economics works, and what happens. And it's interesting. Over the years, I will say that there's a big difference in terms of the sophistication of the type of transactions, not necessarily sophistication from a knowledge standpoint. And that's the mistake people make sometimes. But from a complexity standpoint, it is much more complex in the big worldwide banks and the money center banks and all of those kind of things, than in the smaller banks and the local banks. And that's, and you say smaller banks now, it's kind of crazy. I was just Randy Pennington from Center States was making a presentation this morning, talking a little bit about banking at Martin County Business Exchange. And, it's interesting. Many of you probably heard they're merging with South State. They're actually going to change their name, although the charter is going to remain under the Center State. But it was a merger of equals, truly real close to almost exactly the same. I think both of them are about 17 billion in assets. Can you imagine that? 17 billion. I remember when I started out in Chicago, and we had American National Bank, I think, was about about 3 billion. Walter E. Heller, which was the parent company, was a little over 6 billion, and they were one of the largest financial companies in the world. I remember First Chicago, Northern Trust, Harris, they were all probably under that $6 billion level back then. And now we're talking about what amounts to regional banks. A combined regional bank will be 35 billion in assets. So it's going to be roughly the 35th largest bank in the United States, I guess. And so I'm just mentioning it, kind of getting the word out there. People get nervous sometimes when they see those things, especially since the name is going to change from Gulfstream to South State. But understand that it's still the Gulfstream. I was under the impression that South State was the larger organization. They're not. I believe that probably the routing and transit number and all that stuff will stay the same. So for those of you that are dealing with worrying about having to change your bank accounts, you shouldn't. Here for Center State, you shouldn't have to do that. I don't think. They're going to remain the same routing and transit number. I think they're going to use their platform for online transactions, mobile transactions, and things, because they had a more sophisticated retail application for that. So anyway, just so you know, that's kind of what's going on. It's funny though. It always hurts when we lose a local bank, and we do lose the bank from the standpoint that it is now got another bank. It's bigger. Its focus is going to be, probably not. I mean, it'll still be focused on local, but the main bank is going to be focused on major companies, larger money center, mid-market banks. Its headquarters, I think, is still going to be in Winter Haven, but it's going to be it's going to be a different bank. Lending wise, it might be, might be better because one of the things that the big banks can do is that they can throw money at you. If you think about it, if you're a $35 billion bank, and you're talking about probably a $35 million loan is really even not significant in their whole scheme of things. It would be, as we in the banking world refer to, or in the audit world refer to, as immaterial. So it's going to be interesting. That gives them locally, if you're looking for a 250 or 300 or $500,000 loan, that can probably be done by somebody right here locally without any kind of intervention, which was probably even better than the way it was with Center States, because with Center States, you may have had to go outside of the region for an answer. And in fact, the region now will be large. It is large. George Haley, who's been in charge of and was at the old Gulfstream as one of the senior VPs, he's now staying at, he's going to be in charge of the region from probably Jupiter, I think, all the way up to, I forget how far it goes up. But anyway, it's a big region. So anyway, I just wanted to make sure that people are aware of that. It does make sense, though, I think, and as you know, I don't think anybody should panic on their financial situation. Look, but it's gotten to the point where when I was in banking years ago, we almost always had a secondary banking relationship, always, from a business standpoint, and that was, you just never knew what was going to happen, and you never knew what was going to change, what was going to occur, and all of a sudden, you don't have any banking relationship because your primary bank changes or their philosophy changes or whatever. And I think nowadays it makes sense to do the same thing. I think that putting all your eggs in one basket, and I've been a big proponent of putting all your eggs in one basket with a local bank, because they get to know you, they know what you've got, and they can make decisions. But I will say that at this point, I don't know that I think I would have multiple banking relationships, including multiple loan relationships, so that you've got those sources that you need to draw if you need to draw on them. That's not to say that I would abandon my primary relationship, but I probably would look at developing a solid secondary relationship that was close to the first. And I know that's a kind of a problem because you got to basically have a couple different bank accounts, and you got a couple operating accounts, but most of us can make that happen. And especially if we have a couple different types of businesses that we're dealing with, we can focus one of the businesses on one bank and the other business on another. But anyway, so that's what's going on with Center States. Like I said, it's a merger of equals is what's going to happen, but it'll maintain the South State name over the Center State, which is kind of weird, but I guess it's because the bank is focused regionally. The bank South State's headquarters, I think, are out of Charlotte, and they cover all the way from Virginia all over the Southeast, Alabama, Georgia, all of the, they were in Florida, I guess, not quite as much here. Center States is bigger Florida, but they'll go all the way, and cover all of the Southeast here. South Carolina, North Carolina, Georgia, like I said, Virginia. I don't know if they're in West Virginia, and all the way down. So anyway, you'll probably hear more about that coming up. So I just wanted to let you know, as I've said before, the lending market is tough. This may make it easier for the small companies to borrow money, which is a good thing. It may make it a little more difficult if you're a mid-market, not a real big company, but not a real small company, somewhere in the middle. It may be a little bit more difficult, but But anyway, so just look at that. Maybe if you're dealing with it, either one of those two banks, but especially Center State, give your local person a call. It's funny. We were talking this morning at the meeting about Center State, and it's funny that our local Center State Bank really has been around. Even though the bank has only been around for 21 or 22 years or something, as the original Gulfstream, um, the people, many of them, have been around for 35 for all the time that I've been here in Florida. I moved in '86, and I was a banker at the time. So, a lot of these guys were, well, some of them were so young that they weren't even, out of school yet. That tells you how old I am. But a couple of the guys that were involved in founding the bank and the old Gulfstream Bank were here as competitors with the old Barnett Bank of Martin County and to some degree Palm Beach County as well. But it was interesting because George Haley was a loan officer and at the old Barnett Bank. He was I forget what area he was in. I think he was primarily installment at the time or whatever, but he was just getting started. John Tranter was there. That bank, Barnett, was truly a big bank that was that really acted like and functioned like a smaller bank. They had their own board of directors who had authority. A lot of the banks in those days had their own board of directors, but they had no decision making on any kind of loans. All the loan decisions were made, by somebody else or internally. But Barnett and Martin County, they used to, they had their own board, their own lending authorities, and the interesting thing is that that Barnett office at in Martin County was the stepping stone to Barnett, the holding company, and ultimately executive positions in the bank itself, not just in the office. Even though the Martin County was a smaller location, because it functioned very similar to the holding company in terms of the way it acted and responsibilities and the way that the people dealt with it. It was a very sophisticated small bank, but very, very customer service oriented. And it was kind of an interesting thing. They were a model for a lot of other holding companies, that were just starting to form back then. And that's what you had back then. Rather than one single bank, you had a holding company and a number of individual banks. But Barnett Bank of Martin County was a model for not only other Barnett branches or Barnett banks, but also for a lot of the other banks that were starting here and over in the West Coast. And the people that were involved truly did understand how you could make a big bank, a small bank, for a customer service standpoint. And I got to give George and John and Roy Warren, some of those guys, a lot of credit for bringing that culture to Gulfstream initially, and then to Center States, and hopefully they'll bring that same culture to South State and move on. I think we're going to see we're going to start seeing some transition in the banking industry. I really do. It's interesting that I think that a lot of larger banks were, they were protected during the recession, unfairly so, at the expense really of the smaller banks in terms of their ability to compete. And so what's happened is that, frankly, the smaller banks have had to consolidate, because if you're a $5 billion bank, a $35 million loan is a significant loan to a $5 billion bank, potentially. And that $5 billion is pretty large. Like I say, that was as big as First Chicago in the day when I was back in the 70s. So that's a big bank. At the time, probably, I think First Chicago was probably one of the 6 or 7, 5, 6, 7 largest banks in the nation at the time. And yet, now we're talking about a small bank, but 35 million is a big loan. That's one that's significant. And so, they couldn't afford to make those big loans. They couldn't afford to make a $250,000 or $400,000 line of credit or loan that they were potentially going to lose without full underwriting, guarantees, your house is collateral, all kinds of things. But the big banks, that they're big enough now, too big to fail, that they can afford to make some of those loans. And frankly, the small banks have to get to that level that they're too big to fail too. They have to get in that same category, which means they have to get their stock traded on Wall Street instead of regional sales and things like that. They have to get to that size. They have to get to the size they can leverage out their deposits so that they can get bigger, because now being $1 billion and $17 billion doesn't mean a whole lot. I'm waiting for the banks to reach the trillion level. And then you have a lot of non-bank competitors. So it's gotten to be a different market. And I think we're going to see that. I've been kind of, the other thing is that's happened, and it happened to Gulfstream. I think it's the reason Gulfstream sold out to Center States, is that the individuals that founded Gulfstream, they had a lot of their own personal money tied up in that. There was a lot of capital involved, a lot of their own money. And I think they were happy, not necessarily getting that money back right away, having a good bank that was a community bank. But when the recession hit and they saw that, that they were not too big to fail, and they were being put at a disadvantage versus Citibank and Bank of America, they realized that they could be a sacrificial lamb. They could go away if the government just got a whim. And the government was getting a whim in those days. And anybody who's been at any of those banks, Seacoast, Gulfstream, they know how tenuous it was back there. And some of those banks didn't make it. They're not here right now. We're not talking about them because they're gone. And so I think that probably the shareholders of those banks realized that, I need to get out and cash out, so I can get my money out, make a little return maybe, and make sure that it's time to get out of the community bank. And that's always been the case over the years. Banks come and go, they get merged out. People form banks and they hold them for 8 years, 10 years, 5 years, and then they flip them and get out of them. Usually then they start another one. What's not happening now is nobody's starting any community banks. So we're finally going to see the consolidation that we didn't see, I think, for years, because what would happen is these banks would consolidate, but then they would always have competition. The Gulfstreams of the world would start up. The Harbor Communities would start up. All of these banks would start up and would become major competitors. But what's happening now is nobody wants to take that risk, because if you're a startup, even if you got $10 or $20 million in capital, that money's gone potentially if we get a big recession. The government's not going to protect you. They're going to protect these bigger banks. And so it becomes too risky of an investment. You don't have any control over your own decisions. You're at the whim of the government, because the government highly regulates banks. They can't just do what they want to do. Ask them, tell them you want to open a branch. Tell them you'll pay for it, and see how long it takes them to be able to get the branch approved. It's not something that, tomorrow they just buy a space or rent space and they've got a branch. You can't do that. It's a process, and they have to show that they're doing Community Reinvestment Act responsibilities and things like that. So what we're seeing is, like I say, Gulfstream was a pretty strong bank before the recession. I think they were 5-star, Bauer 5-star, whatever. They dropped down. Most of the banks, the small banks, dropped below 3. Some went to 2. Some went out of business. But most of them hovered. The really solid ones hovered at 3 or so. But they were still just a breath away from a 2, which would be pretty much putting you out of business. That was a bank that would have been under regulatory supervision and, with the potential for closure. So I think a lot of the stockholders at that point said, hey, when the market came back a little bit, when we got past into the, 2012, 13, 14, the banks started stabilizing. What happened is some of the larger banks started gobbling up smaller banks. Some of the stronger banks started gobbling up. But what happened is, like in the case of Gulfstream, I think was about, $500 million, $500 million at the time. And they got gobbled up by Center States, who was a couple billion at the time. And so their shareholders cashed out. Now we have another bank, Center States, who also has stockholders who have been involved just about the same period of time. They're seeing their stock rise now and are starting to look at the same thing. So, this is a merger. It's not necessarily that one bought the other out necessarily. They've actually, kind of merged, but it will make them large enough at 35 billion that they can list their stock. There'll be enough transactions in their stock that any existing shareholders that want to cash out can probably do it. Anybody that wants to hold on can, but the existing shareholders can start cashing out, including the Center State shareholders who may want to get out, or the South State. Usually there's a period of time, about a year, where you can't necessarily do that, but it's still it's still an opportunity ultimately for the smaller banks to get out. And so now look around. What do we have? We have Seaside, which is here locally. They as far as they're a Florida bank based out of Orlando, I believe. Still, they have some offices in South Florida. They have an office here in Stuart. There are some again, some people that were locally involved. Originally, the guy that started that bank, Gideon Haymaker, was the president and CEO of SunTrust locally here on the Treasure Coast for prior to the time that SunTrust sold out. And actually, at the time, it was Trust Company of Georgia and Sunbanks, and then they merged, became SunTrust. And I think at about that time, Gideon pulled out. He was there for a while, I think, left, stayed on the sidelines for a while, and then formed Seaside out of Orlando. So that's kind of still got a local connection. But it goes to show you, we had a really good banking market here for smaller banks. And it was a bank that a lot of people grew up in and went on to bigger and better things. And, you look at Seaside's, I don't know how many billion they are right now. They're at least as big as Center States was, I think. But anyway, they're pretty large, big presence in South Florida, big presence in Orlando. So they're still around. But other than that, you start looking and most of the other ones have gone away. The other one is Seacoast. And so you got to ask yourself, when Seacoast almost went under in the recession, and they got a big bailout, and of course the stock was fairly heavily diluted at that time. Now that's kind of changed around. The stock prices come back. I think Seacoast bought some of those shares back, and I think that it's. But if I were one of the original founders of Seacoast, which I'm not, I wish I was, but if I was, I'd be looking seriously at whether or not it makes sense for us to be independent still, or whether we need to merge. The interesting thing is that that Seacoast has always been kind of the size that it was hard for them to be bought out by someone other than, they could do a merger, but there's not that many banks around now that are the same size. I guess, probably this new bank and Seacoast, I don't know what Seacoast total assets are now, but they've got to be probably close to 25, 30 billion, I would think. But because they have offices in Tampa and Orlando and up in the Space Coast and all over in South Florida. So it's interesting. They have to be a target, but probably a target for a much bigger bank. Somebody like a Citibank, who doesn't have a significant presence here, particularly in the Treasure Coast, but probably does, but still has an under presence in the state. Or a Bank of America, although they probably don't need the footprint. TD Bank might be a possibility, but again, there's too much overlap there. So now maybe you're looking at a Wells Fargo, maybe you're looking at a PNC, I don't know. But at some point, I would think Seacoast they have limited partners, so naturally it's going to be more difficult. And frankly, you're probably not going to get as high a price because there's limited buyers. There's not as many buyers because you're too big to swallow. That's the issue, is it makes it difficult. So Keep an eye on the banking market. I actually thought some of this stuff would have already occurred prior to December 31st. I kind of thought some of these things would have wrapped up a little earlier. They haven't yet, and there hasn't been. This was an announcement recently with South State and Center State, so that's an interesting thing. Um, so it'll be interesting. You know, the other thing that we haven't seen, but May is more international banks coming in to the United States and trying to get a presence in the U.S. And you know, they're going to try to compete with the big banks. So for them, you know, they want to gobble up a couple big regionals. You know, get them out like a Synovus and a Seacoast and a Center State / South State. You know, those kind of banks. You put that together, and you know, you're easily up to a couple $100 billion, and you can be a major player in that business. So so we'll have to see what's going on. If you're holding stock in one of those banks, I wouldn't sell it right now. It's probably holding it long term. I don't know that I'd do that, but in the next year or so, until that merger is announced and you get to take advantage of that price, I would, because these prices will always be in excess of what the market is trading at, almost always. So the question is, will they get rid of that stock prior to the time the next recession comes? Because if the next recession comes, you don't want to be holding the stock during the recession in anybody other than the big 5 or 6 banks. It doesn't make sense. So we'll see what happens. Anyway, that's kind of some of the stuff going on in the banking world. Wanted to mention that. Couple things from a tax standpoint. Most people are starting to look at their tax returns. You can now file. The IRS is accepting returns. If you haven't received certain documents, you may want to consider not filing yet, because it might hold up your return. The IRS is trying to clamp down again on identity theft, and the only way they can do that is kind of hold up your refund. So, you know, if you have some key form, you know, they've pushed up the period of time in which the W-2s have to be sent in, and trying to get all of those. It used to be that you did your W-2s by January 31st to get to the employees, then you had till the end of February to get to the government. That's kind of changed now. You have to get all that stuff in at the same time. But the government is they're granting extensions on that for legitimate reasons. So, for example, your 1099s from your brokerage firms, 1099 INT, 1099 DIV, those forms are being, they're supposed to be out by the middle of February, but many banks, many brokerage firms are getting those out with the caveat that this is not going to be the final. Because they have investments that haven't been reported to them yet for the end of the year. So if you've got stocks in any of the investment funds, there's a good chance that you've got money invested in a company that is been affected by the tax changes, and as a result, there's a credit, especially if there's a pass-through type entity, there's a credit that's coming through. Now, granted, a lot of Wall Street companies are not pass-through, but there are more and more of those kind of things. There are more and more hedge funds out there. There are more and more funds that have formed like hedge funds. So, there's more of that type of thing out there that's coming through. And, so it's holding up the 1099s, legitimately holding up the 1099s from the brokerage houses or amended ones. And I'll tell you, just as a warning, I know people like to get their tax return done early. If you have a substantial, even a halfway decent amount of stocks and bonds through through a broker, through TD, wherever you're at, whether you're one of the online brokers, online companies, or if you're with one of the brokers, I would warn you not to file a return before April 15th unless you're okay with paying twice. Because if you file and then you get an amended return, you get an amended document, and so that requires you to file again, you're going to have to make a decision. You're either going to have to give up that tax break, which would save you some tax dollars, Or so you got to be good with that, giving up that break. But if it requires paying taxes, which from time to time it may, if these things change, then you're going to have to file an amended return at that point. And there's a couple things that you need to know about that. First of all, an amended return is, even if you're just changing one number, is not really cheaper to file than a regular return. It's actually uh, a little bit more difficult because you've got to do another tax return with the new numbers in it. Then you've got to do the amended return. You cannot file the amended returns electronically, so they have to be mailed in. It's going to take a lot longer for the government to get it. They're going to be on you by now because they've matched it up with your tax return and know that you didn't report the number correctly. So now you're going to have to deal with that because they may not have handled the change correctly. They may not picked it up correctly because they may not have had your cost basis. So now all of a sudden you're looking at a fairly significant amount of correspondence with the IRS. And the other thing is that when you file an amended return, the government has a limited amount of time in which to review that amended return. Basically, the statute of limitations starts, and they've got about 3 years from the time that return comes in. They've got 3 years to audit that, and whereas they have more flexibility on a regular return. You've got a better chance that your return will get looked at by somebody because they have to look at it now. They didn't before. Before it wasn't selected for audit. They don't care. They don't have to look at it. They go by the regular statute of limitations. But now if you file an amended return, they're stuck with the statute. Once the statute's run on that for them to audit, then they can't go back and audit that return. Well, frankly, most returns are not going to be audited for at least 2 years after you file. The government doesn't audit, other than electronic audits, they don't audit anything from April 15th through October 15th because you can automatically extend. So they don't have the returns to start doing some of their audit work at that point. They don't have the whole portion of it. So they're going to roll that over into the next year, so the beginning of 2021. And frankly, because the IRS is so busy with the taxpayer assistance program and people coming in with questions and information, they can't do any of that work between January and April. So basically, the first time you would get audited, other than, like I say, a matching audit where the documents didn't match what you reported or the government couldn't find it, you're going to be talking about somewhere after April of 2021, normally, before that process would start. So, you're a year and a half just about into the process, at least a year into the process of a 3-year statute of limitations. Now, on the other hand, if you file an amended return and that amended return gets filed April 30th, they're going to have to start selecting. They can't wait until April 30th next year to start, to start making determinations because they've lost a year of the statute of limitations already, and they can't audit you. So they're going to at least want to get that through the process quicker. And, it may not, your audit may not start quicker, may not be in a shorter time frame, but what happens is that you'll be on the top of the list because they have a limited time to look at yours. So keep in mind, that's something you need to look at. There's 2 things I just mentioned. There's a new question on the 1040. If you're filing your own return, there's a question about whether or not you had any virtual currency, Bitcoins and things like that. You need to be familiar with, if you're doing that kind of stuff, you need to be familiar with what the tax laws are in that area. The IRS is going to be all over it. Bitcoin is not coin. It's not currency like dollars and euros. It's considered to be an investment that trades. So you've got to gain when you use it. So let's say you had, $2,000, dollar equivalent Bitcoin. You have to go back and see. So when you executed that $2,000 transaction in exchange for the Bitcoin, you have to go back and see what you paid for those Bitcoins and potentially buy individual batch, because you've got to know, what is it, an average cost? You've got to know what your cost is on your Bitcoins. You've got to follow the government requirements in terms of the recognition of that cost, either specific identification or an average cost method. And then you've got to report those and recognize a gain or loss transfer of those Bitcoins. So the other thing is a lot of those transactions are occurring off the grid. It's almost a barter market. Well, remember, if you barter goods and services, so let's say you exchange, CPA services for Bitcoin, which is basically a barter transaction in effect. From your perspective, that transaction has to be recorded. The sale of the Bitcoins has to be recorded. The fair market value of the transaction has to be recorded. So that's that's what's going on. They're looking at that this year because Bitcoins are used in a lot of barter transactions that aren't being reported, in a lot of financial situations that aren't being reported. They're being used to move money around internationally, and that's not being reported. So just be aware that question's on the tax return, and if you've got those, be prepared to at least address it. From what I understand, there's going to be 3 questions that you're going to get when you fill that out, or 3 letters that you could potentially get. 2 of the letters are just informational, don't require a response. The 3rd letter is one that you have to respond to, and it is one that not only do you have to respond to it, the other ones you might have to send in something, but the 3rd one is one where you're going to have to basically prove they've got documentation showing that you've incurred or entered into Bitcoin transactions, and they want to make sure that you reported them and they didn't find it on your return. So those are the kind of things. So there's going to be 3 of those that are going to be generated by that, and just so you know. So that is on the return. I think it's on the top of Schedule 1 is where it's at. So you might miss it. It might carry forward to the front part of the return, but I don't think so. I think it's on Schedule 1. Also, there is a new return if you're 65 and older. There is now a 1040 SR. I don't know why. It's exactly the same, I think, as the 1040, the regular 1040. So I don't know why they've decided to single out old people. Maybe they're going to leave us alone. Maybe they're going to target us because they think we can't do a return correctly. I don't know. I mean, they know my birth date already. So, I guess if they were going to target me, they already know, they could automatically match up. And if they were looking for my return saying, okay, I want all manual returns that were self-prepared or manual. I want all those returns for anybody who's 65 and older. We're going to look at those closer because they can't see as well and they might make mistakes. So, and again, keep in mind, the IRS doesn't care. They're not looking for you specifically because you're cheating. They're also looking for mistakes. The more complicated the tax laws get, the better chance they have of finding a mistake. And some of this stuff still isn't clear. So, just be aware that that's out there, that SR, I think you have to use that form if you're over 65. I don't think you have a choice, either one. So I think you have to use it. I know my tax software automatically defaults to it. We have an information sheet that has the age of the taxpayer. Once the age is there, it automatically defaults that. So I assume it defaults to it because you have to use it. Normally we wouldn't care otherwise. So anyway, so that's something to be aware of as a change, the Bitcoin question and the 1040 SR. The tax stuff has been clarified a little bit more. It is, especially as it relates to some of the business deductions, the 199A. Just so you know, if you're getting your stuff together to file your tax return, to get it to your CPA, there's a lot of confusion about deductions and what's deductible. I've heard people say you can't itemize anymore. Well, yes, you can. It's just harder because it doesn't make sense, but you could still do it. And so here's what I'm getting at with that. Let's say you itemize your deductions. When you itemize your deductions on Schedule A, there are certain limitations on those deductions. For example, medical this year, you have to get over 10% of your adjusted gross income before it becomes deductible. And then it's still limited to, the total on your Schedule A for itemized deductions. So let's say I end up with, I have a mortgage. Let's say that mortgage isn't limited. I have some real estate taxes. Let's say the real estate taxes aren't limited. I have some sales tax. Let's say the sales tax isn't limited, because I'm not over $10,000. So let's say I'm able to itemize some of those things. I have some charitable contributions. All of those things are still deductible. They're just potentially subject to some limitations, but they're still deductible. And now I get all those, and that totals $23,500. Okay. Well, I could put those on Schedule A, but I can ignore all of those deductions anyway, and I can just take the standard deduction of $24,000. It's 24,400. So I can either get all that information together, accumulate it all, put it down on the form, open it up to review by the IRS, because they have documentation on some of that, so they may challenge some of those numbers if you've calculated incorrectly, whereas I can just get the full $24,400 deduction. So I'm not going to itemize, because the government now gives me that deduction without itemizing. So why shouldn't I just take it? Yeah, I can't deduct those other items, but I don't have to. They gave me this freebie. It's a $24,000 freebie. So why should I even mess with it? I don't need to. And that's really the concept. And so therefore, you don't need to have all those things. And what's happened is the government has capped a lot of this stuff. So there are fewer and fewer people who even would have enough deductions to itemize. So for example, interest on a mortgage. It's limited to the interest on $750,000 of acquisition mortgage. That's your original mortgage when you bought the property after it was paid down. So if you've refinanced and you've got a $750,000 loan, here's the example I'll use. Let's say you bought your house for $500,000 15 years ago, and you borrowed $400,000 against it. Okay. So now you got $400,000, and you paid that loan over the next 20 years. You've paid that loan down to from $400,000 down to $100,000. So you owe $100,000 on it. Your house now you bought for $500,000 is now worth $1.5 million. All right. So you say, you know what? I want to buy a second home, or I want to pay off some of my other stuff, my credit cards, or I want to do, something like that. I just get it all cleaned up. So I'm going to go ahead and go in, and I'm going to refinance. And so I go out and I get a $500,000 loan, which is really the price of my house originally, but I got a $500,000 loan. So I'm under the 750. So you'd think, okay, that's all deductible. I'm under 750,000. No. The portion that's deductible is 100,000 of the 500, because you had paid your original loan down to 100,000. That was your original acquisition loan. So you don't get to deduct. You don't get to deduct $500,000 interest on $500,000, even though you have a 1098 that says that. And by the way, your 1098 now is got a place on it to indicate when you first took out that mortgage. So they're going to know if it's a refinance. They can easily check the county records to find out if it was a refinance, whether and when you and what the original loan was, because there's mortgage documents and things like that on file. So they have ways to check this now, and they are going to start doing that. So this year, if you are deducting mortgage interest on Schedule A, you've got a much more cumbersome process, because in the old days, you just give the tax preparer your 1098 and let them go to town, right? It's on there. They just put it on the return and deduct it. That isn't going to be the way that they're going to have to do an allocation now. And in some cases, if you used some of that money for other than your house, let's say you used it to buy a car or credit card, you might not get a deduction at all. That has to be allocated out completely. You may have used it for an investment, which in that case, it needs to get reallocated as investment interest expense, not as mortgage expense. So there's a whole allocation process. So you can see now why, even if you are eligible for some of this stuff, it's not going to be easy to do it, and you're not going to get as big a deduction as you used to get. So the old days when you had, when you were able to deduct, $35,000 worth of interest expense, with today's interest rates, most likely that's not happening. And that's what happened. A lot of people refinance to take advantage of the lower interest rates, and so they don't get to deduct all of that. And some people took money out because they wanted to maybe put some money aside in some investments for retirement or whatever. They wanted to pay it out over a period of time. Maybe they were buying some health products, some annuities, some long-term care, whatever. So you got to look at all that, because that's all going to change, and some of it's not going to be deductible. Again, you got a $10,000 state tax deduction. That includes taxes for your income taxes if you pay income tax in another state. That includes taxes for real estate taxes if you pay real estate taxes in multiple states. It's not $10,000 per state; it's $10,000 total. So you're going to be capped out at $10,000 for that. So those items are going to be limited. One of the things that some of the states tried to do this year or last year is they set up these 170C organizations or whatever. They're basically charitable organizations that, in exchange for your charitable contribution, you get a state tax credit. Those are not going to be deductible, and they're going to trace those credits. You're not going to be able to use those credits as a deduction. You're going to have to consider that deduction to be offset. So there's some of those things out there. They're really after all of that stuff on Schedule A is gone. You can technically do it, but there are a lot of rules, a lot of limitations. Like I said, medical expenses is 10% of AGI. So generally, unless somebody's got a significant amount of charitable contributions, 30 or 40,000, 25,000, or they have a significant amount of health costs, say a nursing home, significant home health care, that kind of thing, they may still itemize. It might be higher than the standard, especially if they're a single person. It might be enough to itemize, but there's going to be limited cases. Business deductions. Let's say you're an employee and you have expenses for your car, gas reimbursement, office in the home. Boom, all gone. You don't get them anymore. Tax preparation for individuals, not deductible. Investment fees for individuals, not deductible. All of those things are not deductible. Don't bother going and looking them all up. Don't go through all those receipts to find $6,000 worth of, employee business expenses. They are not deductible. So just forget about them. Now, if you're an actual business, you've got a LLC or corporation, and you've got business expenses there are some different requirements. So there you may have some deductions, but if you're an employee, the old employee business expenses are gone. You don't get them anymore. So you need to take a look at that, including business meals and all of those kind of things. So anyway, so that's kind of just a brief summary of some of the things that are going on in the banking world and the tax world. We'll talk about some of these other things coming up. And so right now, I guess I'm running out of time. I guess, Evan, probably about 30 seconds left here. So it gives me just enough time to tear up my script for today and get that into little pieces while we finish, because I thought that was such an appropriate thing to do last night while I was watching the president speak, that I thought I personally would do the same thing. So here I go, ripping up my speech right here on WSTU Digital 1450, because we are Martin County's really, 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 really old station.